Coming up today, stock indices close at all-time highs, along with Nvidia. Is the market already pricing in an election winner? Bitcoin bounces back, the changing tune at the Fed, the latest from China. Google partners with a nuclear company, my reaction to the Starship booster test, and everything else to get you prepped for this week. Let's have a good one, guys. And a warm welcome back, everybody, to the Daily Market Review. Hope you had a good weekend, and what another great start to the stock market this Monday. S&P 500 rallying up once again, closing at a brand new all-time high, 58.59. Doesn't look like all that October seasonality is playing out. Appears to be stocks are just grinding higher when everything was pointing for October to go lower, coming into Q4 hot. Election year. However, apart from forward earnings estimates and stock buybacks at all-time highs, in my opinion, and I know this is a little controversial, another factor that could be driving stocks for the here and now is the market may be pricing in a Republican win for the election. And stick with me because I'll show you some data to back up my opinion there, along with some assets out there breaking out to new all-time highs, and I'm sure a lot of you have never even heard of these assets I'm talking about. So I'll show you those later on, along with giving you an update on what we heard from China over the weekend and everything that's going on there. Good news for uranium bulls like myself, as I'd been forecasting the last couple of months. More and more big tech company getting into nuclear power. We just heard that again today with Google, so I'll touch on that a bit later on, along with everything else going on in the commodity market. And stick with me today because I'll let you know a stock I just added to my long-term portfolio and why I believe it could be one of the biggest companies in the world in the next 10 years. But first off, let's just talk a little bit about this soaring stock market, reaching for the stars once again here today, even though everything suggests it should be lower. And we're pretty much at the halfway mark for October now, so we could still finish lower. However, the higher we push up, the lower those odds become. And something that's really helping to drive the indices higher today, and what I'd been alluding to for the last couple of weeks, is the AI trade is back on. Nvidia still got lots of bullish seasonality and just closed at a brand new all-time high today, $138 a share. Didn't quite make it up to all-time highs from where we traded back on the 20th of June, just above $140 a share. However, that's looking very likely in the coming days. And so semi and chip stocks had been getting tested for a few months there. We're close to breaking some key support, but it looks like we've just had a healthy consolidation, which looks to be close to breaking out once again on excitement for Nvidia's new Blackwell GPU chip. Apparently is already sold out for the next 12 months. And we're hearing reports that their initial pricing is $500,000. They're pretty much just slapping whatever price they want on it, and the biggest, most cashed up customers in the world are jumping head over toe to get in line to buy it. The explosion in CapEx continues. Nvidia is still king. No one's close to overtaking it, and the AI boom is alive and well. And so for the first time in a long time, the fear and greed index has just gone back into the extreme greed zone at 76 here. Keep in mind, that doesn't mean we're about to fall straight away. Stocks can get overbought and stay persistently overbought for some time. And just looking at my own S&P 500 oscillator, which is a bit more refined than the fear and greed index, that hasn't quite gone into overbought territory yet, like we did here back in mid-July. And so this momentum and uptrend is really strong. We can see the market color just green across the board. Looking underneath the hood of the stock market at sector breadth, pretty much green across the board, and sector performance year to date. Every sector up since the start of the year. In fact, we got utilities up almost 25% year to date. Tech and financials coming in third and fourth. Down the bottom, REITs and energy still up 8 and 9% though. However, skepticism is aplenty. Every day in my feed, I'm getting tweets like this. Sold half my long-term portfolio this week after 8 years. Kind of sad to do it, but this market is charging headlong into a train wreck next year, in my view. And that is definitely a building narrative and consensus. Pretty similar to the last 2 years actually, going into 23 and coming into this year. And for good reason, as for sure we could get a recession next year, if not a resurgence in inflation. Both scenarios really bad for a lot of stocks out there, but some are certain this is happening. Another one today, forecasting a crash in 2026 that will make 2008 look like a warm-up. A 60% stock crash and a 30 to 40% wipeout in real estate is almost a certainty. So many people on the sidelines certain stocks are going to pull back either next year or 2026, which, don't get me wrong, very well could happen. I'll never tell you that something's definitely going to happen because no one knows for sure. Not even Warren Buffett. That's why we follow the price action trends along with important data to position ourselves correctly no matter what happens. But wouldn't it be funny if, just like the 3 prior secular bull market, each becoming bigger than the last, wouldn't it be surprising to many if this one actually went on to become bigger again and we're only halfway through a really long-term secular bull market? Because by some measures, we actually had a longer one from 78 to 2000, 22 years. So if this one started in March 09, about 15 and a half years in, it's nothing to say it can't go for 30 before we get that 50% correction a lot of people are worried about and are on the sidelines waiting for. But the fact is, and probably the most important number the market really trades off, is forward earnings expectations. And that's just simply been climbing and climbing pretty steadily for the last 2 years, currently sitting at all-time highs, and you'll find that correlates a lot with stock market performance and can start rolling over before we get a recession as well. And so for the here and now, the momentum is well and alive. It's just simply not rolling over. And like I said, companies are buying back their own stock at record level. Very supportive of the stock market, literally depleting the supply of shares out there. Companies are buying back shares. All our pension funds are constantly buying shares. Corporate earnings at all-time highs. Momentum, government spending off the charts. There's a lot to go against for a bear. But I do understand their main argument. The data I'm most often reminded of is the market cap to GDP, which for sure is at an all-time record. This data is a month and a half old, so it's probably even higher now. We're probably at about 210% the US market cap's value to its economy as measured by the gross domestic product. That's more than 2 standard deviations above the historical trend line. And this chart's 10 years old. However, it gives us a look at the market cap as a percentage of GDP all the way back 100 years ago in the roaring 20s, and which had only got up to 88%. However, like secular bull markets, looks like over time we're making higher highs and higher lows in the stock market's valuation. And again, there are key differences. And I think when I say that, people will then say, oh, are you saying it's different this time? And I think that's a bit overplayed, the connotation from that expression. Because in my opinion, history can rhyme, but it doesn't always repeat, as there is key differences between now and back in history. The Fed put was only created in 1987. Massive intervention in markets. American companies able to easily distribute and sell all around the world. Pension funds constantly buying up. Share buyback. The ease of access. Stock market. Anyone with a smartphone around the world buy US stocks with a click of a button. All of this, I believe, has created a secular trend in valuations to go higher over time. Doesn't mean they can't revert back to a mean, but I believe that mean will be higher. Another key difference this time is the stock indices are dominated by mega cap tech stock, some of which get more than half their revenue outside the States. So measuring the market cap of American stocks to the American economy may not be as relevant as it once was. Maybe the market cap of US stocks should be measured to the global GDP, since America dominates technology around the world. And a lot of people seem to get fixated on just America's stock valuation and think the whole market's going to crash because America's expensive, not realizing you can easily get access to markets outside of America, even with securities listed on American exchanges. Because again, there's no denying it, American valuation are at a historical extreme. US stocks could underperform over the coming 10 years, looking back in history. Doesn't mean investors can't access exposures in emerging markets in Asia Pacific, where valuations are actually closer to the lower end of historical ranges. In my opinion, the world's full of opportunity for those willing to look for it. Countries like Korea, Brazil, China, trading on forward PEs in the single digits, and many other healthy measures of valuation. One market I've got my eye on lately, Brazil. ETF EWZ could be finding support here, and believe it or not, it has a dividend yield 7.5%, even though it holds 55 Brazilian stock. Are there unique risks there? Sure. Can't have reward without risk, but for those that can take a calculated and managed risk, could be setting up an opportunity. And I, for one, have a few Brazilian stocks on my watch list I may be entering. But for the here and now, we're getting into the thick of Q3 earnings season. So far, so good. Still early days. Saw those big reports from JP Morgan and Wells on Friday. Ripped up, and even though the wording from a lot of their earnings conference call wasn't all that great, a lot of people highlighting the negatives. Like I said, money doesn't lie. And it just poured into JP Morgan on Friday. 18 million shares, up 4.5%. Same with Wells, which continued ripping today, and even Bank of America. Traded up in sympathy with it, and the financial sector is sitting at all-time highs as a whole. We're also coming into a pretty bullish period for stock. In fact, the most bullish 6-month period from November to April, where on average the S&P 500 will slap on 7%, finishing that 6-month period higher 78% at the time. However, like I alluded to earlier, in my opinion, and of course you're allowed to disagree with me, is that apart from all the other factors I've already shown you, some stocks could also be pricing in a potential Republican win. We're 3 weeks out from the election, and just looking at the latest odds from Polymarket, in which $1.8 billion has already been wagered on the outcome of this election. Over $500 million to the Republican nominee has recently jumped up in the last month. You can see that here in the red line, the odds, as we're getting a bit of a divergence in the top 2 favorites in this race. We're also seeing DJT stock having a strong rally this last couple of weeks as well, after it being battered down for quite a few months. And there's a look at it today, pushing up on heavy volume, 58 million shares, up 18%, super volatile. A few weeks ago it was trading at $12 a share. Here we are at 30, but like I said, it's been beaten down ever since the start of this year. Things starting to take a turn here. We're also getting news that the dollar may be rallying. Investors could be making a down payment on a Republican victory, which is true. Ever since the Fed cut 50 basis points on the 18th of September, dollar kind of stalled out, signs of accumulation, bullish divergence, and upward pop. But like I said, I'll be looking for some resistance around 103, 104 here. Fundamentals for the dollar are still bad. It's going to take a lot to turn around that shit. However, also bundled in with the Trump trade is Bitcoin crypto, as the potentially new administration pro-crypto crypto. Bitcoin certainly been holding its ground the last couple of weeks, even though we've got the dollar bumping up. Don't seem to care about that at all today. Up over 4.5%. A lot of bullish seasonality coming into it. And I've got a feeling this may come up and test all-time high in the coming weeks and may just pop up above it after the election. And what else is telling me the market could be pricing in a Republican win? We've got some ETFs that are aligned with the potentially new administration policy and view on America. The American Industrial Renaissance ETF, as there's a big drive from this political party to produce back in America, bring manufacturing back, reshore, potentially provide tax incentives to companies that do most of their production onshore. And that's why this little known ETF just broke out to a brand new all-time high again today, again in my opinion. Not only that, but there's another ETF similar, American Reshoring ETF, which plays into exactly that political will, as I just described, invest in US infrastructure, manufacturing revival, it too closing at a brand new all-time high today. And a very new ETF that's very illiquid, not well traded, but nonetheless made in America. US manufacturing ETF, made, already trading at fresh highs. Not to mention the more aged iShares Industrial ETF coming from BlackRock, also ripping up really strongly this last month to new all-time highs. Not to mention another sector that is set to benefit from deregulation and a more pro-business administration, as Wall Street analysts have described them, financials, trading very strong as well. And so just to give you some historical context, for the second last US election, in which it was Trump versus Clinton, market was pretty soft going into it here. We can see in November 2016, and there was a big overwhelming narrative and consensus that if Trump won, the stock market was going to dive and crash. We were headed for World War III. Everything was going to fall apart. And so the next day we had the election. Market gapped up. And I remember all over social media, even big hedge funds shorted the crap out of the market. Some of which actually went out of business and went broke because the market then went parabolic straight away and actually loved the result of the election. And we continued to rally up all the way, pretty much right throughout 2017. Got a bit heated coming into 2018. Volmageddon, explosion of those short volatility products. Market found its footing quickly, consolidated for a few months, continued ripping up. Into late 2018, we had the taper tantrum with the Fed. They gave us the Fed put again right after Christmas. The then president called it the glitch in the stock market, which it actually turned out to be, and we continued to ripping right up into 2019. Things were looking as great as they'd ever looked, and then we got a virus that changed everything and absolutely slammed the stock market in a month and a half. So here we are today, S&P 500 looking a little different. Ripping up on what's typically a really soft month, softest month of the year, especially after a hot year-to-date performance like we've already had, not to mention an election year. So unless we get a big kind of rug pull of a day soon, the market looks to be on firm footing here. Option dealers are still demanding a premium to underwrite risk here though. 9.8 points above realized. So they're still pricing in the possibility markets could move. Still got oil volatility trading at highs as well. Stocks don't even seem to care. Bond yields have ripped right back ever since the Fed cut. Market's starting to price in inflation expectations again. We can see here in the spread, and this could be a theme that plays out next year. Like I said, if we don't get a recession, we could get a resurgence in inflation. Things become too good, too loose. So still definitely risks around the corner. But if you position correctly, you can turn those risks into opportunities. But for a lot of consumers, this is not good because just generally speaking, consumer confidence and their expected financial situation in 5 years done nothing but nosedive in the last 4 years. And this is when inflation's been coming down. Apparently the Fed thinks it's okay to start aggressively cutting interest rates, even though we've still got core CPI on a 3 handle. What happens if we do get inflation come back? How many consumers out there are prepared for another 30 to 40% increase in their prices over the next 3-4 years? And that's why we've got the Fed umming and ahhing. Kind of seem to be a little over the shop now. Just heard that today with Fed's Waller, skeptical of more big Fed rate cuts amid worries of a strong economy that could reignite inflation. He said the economy is much stronger than previously thought and the labour market remains quite healthy. He said this growth could put upward pressure on inflation and that could accelerate because they've quickly lowered borrowing costs. So it'll be interesting to see how history views Jay Powell's most dovish rate cut right in front of an election and their whole strategy of swing trading data month to month. I agree with the tone of this Wall Street Journal article. The Fed has a dependency problem that needs fixing. But that's the thing, even if they are data dependent as they claim to be. Pretty much right after Jay cut 50 basis points, we had the unemployment rate come in lower than expected. We've had some other measures of economic data come in above expected. ISM PMI's pricing, industrial production, and then we just had a little bump up in CPI as well. The way he was speaking, we were kind of expecting soft data right around the corner. Cut 50 basis points. Seems we've been getting the opposite. But it's not just Jay Powell. It's a global easing cycle. European Central Bank set to cut rates for the 3rd time this year when they meet later on this week. Come this Thursday, it's a global monetary policy is getting looser, and that's really supportive of growth assets if the economies are still expanding. However, there's quite a different picture in China. They're still trying to get underneath their economy and markets. To be clear, their economy is not in a recession. Growth just been slowing. Still on a 4 handle with GDP. They want to get it to a 5 handle They really want to get underneath their sinking property and stock market. We just got their briefing on Saturday from their finance ministry. Highly anticipated, did come in a bit underwhelming. Wasn't the big all-in my opinion. I think they could be saving that for later. And we're still seeing signs of potential deflation over there. Their balance of trade just came in. Difference between exports and imports not looking so good. They do have issues over there that are going to take some time to be addressed. But according to one of my favorite analysts on China, he admits there's more work to be done, but he expects to hear more consumption-related stimulus for rural communities in the coming days. And also went on to say Chinese authorities have a tremendous amount of room to increase spending and take on more debt, for which they absolutely do. So he believes this has already been kicked off and that their federal government is going to spend a lot all throughout their country to kind of flood their system with liquidity. And so even though their officials are hinting there's more economic stimulus to come, they're giving us very few details. In my opinion, they don't want to overheat their markets in the short term. So much volatility and craziness kind of whipsaws everyone. I think they're just going to feed this out over time and let markets digest it. And according to War and Chinese Buffett, user over on X, CCP's made it clear they will do whatever it takes to stimulate, and they have the means to do so. According to him, they haven't even really started yet, and that they're going to go all in on this, and so should anyone with half a brain. Now, I'm not quite as bullish as that. I don't go all in on anything. However, we are getting good signs from the likes of Goldman Sachs. Upgrading China growth forecasts on the latest stimulus. They seem to like what they're hearing out of there. Same with long-time successful fund manager Mark Mobius, still actively involved in the business well into his 80s. He's also betting on a China bull market as well. Saying he believes authorities want foreign capital to return. He recently just took a trip throughout China. He was impressed with what he saw. He said, of course, there'll be corrections along the way, but there's going to be accelerating development. And admitted that a lot of people have been hurt by China. They don't want to hear anything more about it, but he expects a lot of money to come in to all of them emerging markets, and that the whole market's going to move. However, let me be clear, it's not without risks. And one of the biggest ones I see, and none of us know when it's going to happen, potential China to go into Taiwan, which could potentially result in Chinese being cut off from Western capital markets, just like the Russians were after their invasion into Ukraine in early 2022. If we wake up to news of that one morning, I'll be hitting the sell button the next second. I won't be waiting for price action to confirm. I'll be hitting whatever bid that shows up on my screen, because I won't want to take on that risk of Chinese capital markets being cut off. And who knows, they may want to delist ADRs. It could get really messy. And that's why I'm keeping my exposure to equities listed in China to a minimum. And I'm looking for other ways to play this with kind of the halo effect. Securities listed in Singapore, South Korea, commodities. Got a whole bunch on my watch list that could benefit from this. Don't come with that explicit risk of Chinese listed securities being cut off from Western capital. So that is a tail risk. But that could happen tomorrow. That could happen in 7 years from now. We don't know when it is going to happen. However, they are determined to reunify Taiwan with the mainland. And there's a look at the China 50 index. Still consolidating around its 50-day VWAP, and I expect this to stay more volatile. But like I said, if we come down too low, I think the authorities are watching their markets closely. They'll be buying the dip themselves with more stimulus measures, in my opinion. Moving on today, something I've been talking about for a while. Mega cap tech moving closer and closer to sourcing their power from nuclear energy. Just about every big company has made investments or has been speaking about making investments in this area. And we just got the latest one today, just reported not even an hour ago. Google inks a deal with nuclear company as data center power demand surges. They said it'll buy power from a nuclear energy company, Kairos Power. Said the first small modular reactor will come online by 2030. So these are big long-term investments these companies are making. AI uses an immense amount of power. More than 10 times power goes into a simple prompt and GPT versus a Google search. And big tech's waking up to the benefits of nuclear power. And I expect to see more and more of this, not only from big tech, but other companies as well. And that's why I'm well positioned. And nuclear-related security starting to shape up pretty good here on the chart after we made a double bottom back in early September. However, we've got crude oil falling to start the week, more than 2% after OPEC cuts demand forecast again. This is on the back of the news that they were going to increase their production as well. The world's flush with production and supply, all-time highs, and I think crude will remain soft until China really bounces back. They start getting back to growth, and if Western economies hold up as well, that should get demand back up. But for the here and now, like I've been saying, it's going to remain volatile. There's just so much at play here. Even though gold is remaining firmly bid, even in the face of an increasing US dollar, I think there's still some geopolitical risk premium built in here. And the BRICS are showing no signs of slowing down their accumulation of gold. Really kicked off in 2021. in 2022. The amount of gold buying they've been doing, also off the charts. And so I thought I'd do something a little different in today's daily market review and share with you guys a stock I just added to my long-term portfolio today. And before I get into it, let me just make it clear that this stock, all of my content, products, and services are not financial advice. I'm just sharing my opinion, thoughts, and positions with you guys. What you do with your own money is completely up to you. Please always do your own research and trade at your own risk. And I don't really own a lot of stocks in my long-term portfolio. As for that portfolio, I run kind of a high conviction strategy. Just investing in a handful of stocks I hope to hold for the rest of my life, can buy the dip. Companies I really know, understand, and believe in. And so I decided today to pull the trigger on Uber, something I've been watching for a while. Had been hoping to get for a little cheaper, however it just got a little away from me. And on the back of this breakout to new all-time highs, I've decided to initiate a position and will continue to add to it on any pullbacks. And so basically my bullish thesis on Uber is that we all know about it, right? It's the world's #1 ride-hailing app, seeing really big growth in Uber Eats as well, delivering food, moving people around town. It's the urbanization all across the world. We're all moving closer to big city centers. The trend away from owning cars. Some even say 10, 20 years, car ownership may be a minority as we're all using robo-taxis, of which Uber could very well lead. Certainly give Tesla a run for their money as the #1 biggest platform and technology, already well experienced in the industry. They just need a license, some robo-taxi tech from a company, partner, or take them out. But they're in multiple industries all around the world, not just ride-hailing, food delivery, also get into freight, got huge operating leverage, global scale, and the potential to evolve into what we see in China a lot, super apps, where you can do everything. Move around town, move goods, food delivered, you name it, just transport. I already think of them as the #1 transport company in the world. Strong brand, and just doing a holistic market cap analysis, 178 billion. It's actually a fraction of the world's biggest company, which are more than 10 times the size of that. And I think Uber could potentially be a top 10 company within 10 years, maybe 15 years or more. Like I said, revenue is accelerating, just did over 40 billion in the trailing 12 months. Nice clean breakout to all-time highs. I would have loved to have bought it below $50 a share. However, what you find with really high quality stocks, and Warren Buffett said this about Amazon for a long time, is they really get cheap and they really become that obvious. You're looking for that 1-foot hurdle. It's very rare you get them with high quality companies. And so again, this is not financial advice. I'm not telling you to buy Uber stock. I'm just sharing with you my thoughts and opinion and a position I added to my long-term portfolio today. But if anyone's got any criticism or why they don't agree with me, then I welcome that. Feel free to post a comment below this video and let me know why I'm wrong. Just as I'm often reminded why I'm wrong about Tesla. I'm interested to hear, is there any Tesla bulls out there watching this video? Because anytime I talk about it, I just get a torrent of skepticism and criticism, which is okay. Not everyone has to believe in Tesla. Not everyone has to like Elon Musk, but I'm always interested to hear and the reasons from the bears. But to be honest, it's kind of the same thing I've been hearing ever since I first bought Tesla stock back in 2010. I think a lot of bears forget you can only make 100% on a short, but Tesla's up over 17,000% since it IPO'd. And for sure, it's not cheap, 700 billion market cap. But after that little dip we had on Friday from their robo-taxi presentation, in which there's plenty of skepticism, I've got some buy orders resting in there at the moment. Didn't quite get hit today. I'm looking to buy the dip again for my long-term position in Tesla. And some people will say to me, I'll wait till it gets to $50 a share, you'll see. I hope it gets to $50 a share. I'd love the opportunity to back the truck up and load Tesla up at $50 a share. Some of these bears know more technicalities about the stock than I do, which is kind of crazy for how much time they spend on a stock they hate, person they hate. In my opinion, I think they're the #1 clean energy brand in the world and their best days lie ahead of them. And I think it could very well hit a market cap above 10 trillion come 2040, which would imply a compounded annual growth rate a bit below 20%, and which it's already done well above that since IPO. And so I'm sure many of you saw the historic feat of aerospace engineering over the weekend. SpaceX successfully caught its Starship booster using metal chopsticks at its Texas launch pad. It's a bit of a milestone for the company and just the space economy in general, as they're aiming to use reusable starships to send people to the moon and Mars. And a lot of people might not realize the Starship is huge. It's almost 20 stories high. Think of it like a small skyscraper in the city, being rocketed into the sky and then caught back on Earth by some metal chopsticks. And so that's bigger than the Statue of Liberty. And before SpaceX came along, most rocket operators used expendable boosters that can only be used once. So Musk really has kind of made them reusable, got the cost dramatically lower. And this is really what's going to take us into the future and beyond. And so he's already talking about 1 hour turnaround for Starships being launched into space, which in my opinion is truly incredible. We're witnessing history here. And again, this could be just the beginning. So we're already talking about spacecraft traveling past Mars and using the planet's gravity to gain the velocity they need to reach Jupiter's moon, Europa, by 2030. And that the next generation Starlink satellites, which are so big that only Starship can launch them, will allow for a 10x increase in bandwidth, and with reduced altitude, faster latency. SpaceX already launches more satellites than every other government and company in the world combined. And it's not just SpaceX and Tesla doing amazing things. Also companies like Palantir with AI, getting more into robotics. There's a lot of great stuff happening out there, and that's already showing up in the stock market. And so in my opinion, I think all this stuff's pretty cool. There's not many other companies out there doing this stuff. And so anyone's free to criticize them. They're free to their opinion, and I'm pretty sure I'll still be sitting here in 15 years from now, hearing the same things that I have been for the last 15, but I guess that's just the way it is. And it's unfortunate to see that some politicians are citing his politics for actually slowing down SpaceX, which Elon's just come out and said he plans to file a suit against them today. So I think we could see the SpaceX IPO in the next 2 to 5 years. And that's why my latest stock pick today was in the space industry, in which I intend to stay invested in it for many more years and only add to it, in addition to my position in Tesla, as I may never ever sell my shares. So I would relish the chance to keep buying the dip. Who knows, maybe down to 180, and if I'm lucky enough, back at $100 again in the bottom early last year. Now it's moving back onto the markets. We got the VIX starting the week off a bit lower here, under 20. Pretty surprising if this were to trade down towards 15 over the coming weeks. Still got TLT pulling back, trying to find a little bit of a short-term bottom here. My third reversal signal. DSI oversold. Institutional buying, really healthy level there, 74%. May find a little bit of a bottom here in long-dated bonds. And there's Apple, still consolidating, just below all-time highs. And even though crude pulled back today, big energy stocks like ExxonMobil and Chevron actually holding up there, trading a bit firm, as are the materials stocks like BHP. And other market leaders like Eli Lilly, still just below highs, as is NextEra Energy. And I've also got my eye, as usual, on some clean energy ETFs and stocks out there as well. Maybe starting to get a bid here. And you know the 1% are still doing well when we've got Ferrari just below all-time highs as well. Market cap 116 billion, more than General Motors and Ford combined. But that's it for the daily market review today, as we're starting to get into the thick of Q3 earnings. Don't have much out in the way of economic data this week. Market looks to be trading on its own devices and is currently running higher. Thanks again for tuning into the daily market review. You're welcome to share your opinion in the comments below this video, and I'll see you all again come tomorrow night.